All right, so this week we're going to do a deep dive into, all this stuff. We've got all these articles on the stock market. It's been a pretty wild ride so far this year, hasn't
Yes,
it?
no, yeah. Definitely a lot to unpack. I mean, you look at how the market started off the year, all those record highs in early December, the S&P, the NASDAQ, the Dow, all hitting those record
And
highs.
then, and then no Santa Claus rally.
Yeah.
Like 2 years in a row. That's got to be some kind of sign, right?
Well, historically, yeah, it hasn't been a good sign. When you see the Santa Claus rally fizzle out like that, it often suggests that a correction might be coming.
So are we headed for a downturn then? Or is there? I mean, is there anything that could keep the market moving up in 2025?
I mean, it's not all doom and gloom. There are some positive signs out there, like, they're talking about potentially extending those favorable tax cuts. And a lot of experts are predicting that the new administration is going to create a more business-friendly regulatory environment.
Okay, so some potential pluses there. But what about those rising bond rates? That's got to be a cause for concern, right?
Oh, absolutely. When bond yields go up, it can make stocks look less attractive to investors, and that can lead to a shift of capital away from the stock market. Definitely something to watch.
Okay, so let's let's switch gears for a second and talk about something that's been doing really well. AI. I mean, one of these articles even highlighted 7 AI-picked stocks, and these stocks were up over 9% in just the first week of January.
It's amazing, isn't it? It really shows you the power of AI in the market. We're not just talking about hype anymore. We're seeing real results. Like, look at Foxconn. They reported a 15% year-over-year revenue increase in Q4 of last year, and a lot of that growth was driven by demand for their cloud and networking products, especially their AI servers.
So it's not just about algorithms picking stocks. Companies are actually using AI to improve their businesses. No wonder investors are excited.
Exactly. And that excitement is spilling over into the semiconductor sector. Companies like NVIDIA, AMD, Broadcom, they're all seeing their stock prices go up because they supply the chips that power all those AI systems.
It sounds like AI is more than just a fad. It's like a fundamental shift that's going to keep shaping the market for years to come. But let's get back to the present for a minute. How did the major indexes actually perform this past week?
Well, after a strong start, things got a little rocky. The markets ended mixed on January 6th. The S&P and the NASDAQ managed to squeeze out some gains, but the Dow ended up in the red. It was a pretty volatile session, reflecting all the uncertainty in the market right now.
Speaking of volatility, we saw some pretty big swings in individual stocks this week. Constellation Energy CE, they shot up over 25%. But then on the other hand, you got Constellation Brands STZ, they tumbled more than 17%.
Yeah, it just goes to show you that even in a volatile market, there are opportunities for both gains and losses. Company-specific news and events can really move those stock prices, regardless of what the broader market is doing.
And then there's Dollar General. One of these articles is talking about how their stock has dropped like 71% from its high back in 22. They're really struggling with slowing sales growth and rising costs.
Yeah, it's a tough spot for them, especially with all the competition from retailers like Walmart, who actually reported stronger same-store sales.
So is Dollar General a lost cause? Or is there any chance they could make a comeback in 2025?
Well, they're definitely trying. They've got this back to basics plan. It involves opening new distribution centers, automating their facilities, and making improvements to their stores.
So they're basically trying to become more efficient. Does that mean that they could be a good buy for investors? Investors who are willing to take a little bit of a risk?
It's possible. I mean, their dividend yield is at 3.2% right now, and that's almost 3 times the average for the S&P 500.
Okay, so there might be some upside there. But is that just wishful thinking? What does the economic data tell us? Are there signs of a broader slowdown that could hurt companies like Dollar General?
That's a great question, and it brings us to some important economic data that came out this week. Factory orders actually decreased in November.
That doesn't sound too good. Could that be a sign of trouble in the manufacturing sector? And what does it mean for the market as a whole? We'll dig into that and more when we come back.
That drop in factory orders we were just talking about, it really kind of underscores the uncertainty in the manufacturing sector right now. It might be a sign that businesses are kind of holding back on investments, given all those mixed signals we're seeing in the economy.
Yeah, that makes sense. If companies aren't feeling confident about future growth, they're probably not going to be spending a lot of money on new equipment or expanding their operations.
Right, exactly. And that hesitation to invest, that can have a ripple effect throughout the whole economy. It can impact jobs and consumer spending, and ultimately that can put a drag on the stock market.
So we've got Helitum, We've got a potential market correction on the horizon. We've got rising bond rates adding pressure. And now we've got this slowdown in manufacturing. It's a lot to keep track of. What should investors be focusing on right now?
Well, I think in this kind of environment, it's more important than ever to be really selective. You want to focus on companies with strong fundamentals, businesses that are well positioned to navigate these economic headwinds.
Are there any, like specific sectors or industries that look particularly promising right now?
Well, healthcare is often considered a defensive sector because the demand for healthcare services tends to be pretty stable no matter what's happening in the economy. Remember Walgreens Boots? They had that massive surge this past week.
Yeah, over 27%. It's pretty impressive. But isn't healthcare also a pretty heavily regulated industry? Could that pose a risk for investors?
Yeah, that's a good point. Changes in healthcare policy can definitely have a big impact on companies in that sector. So it's
Yeah.
really important to stay up to date on any potential regulatory changes that could affect your investments.
Okay, so healthcare could be a decent option for investors who are looking for a little bit more stability. But what about investors who are, you know, a little bit more comfortable with risk? Are there any potential high growth opportunities out there?
Well, we've already talked about AI, and you know that trend is only going to get bigger in 2025 and beyond. But investing in individual AI companies can be pretty risky.
So how can investors get in on that action without betting on just one company?
Well, one way is to look at exchange-traded funds or ETFs that focus on AI and related technologies. ETFs let you invest in a basket of companies, so it helps to spread out your risk.
That's a good tip. ETFs can be a smart way to invest in a high growth sector without having to pick individual winners and losers. Now, shifting gears a bit, there's been some talk about the new administration potentially changing tariff policies. What are your thoughts on that?
Oh, that's definitely something to watch. Tariffs can have a huge impact on companies that import or export goods. If the new administration does make changes to tariff policy, it could create some winners and losers in the market.
And those changes could also have an impact on inflation, couldn't they? I mean, if tariffs make imported goods more expensive, that could lead to higher prices for consumers.
Oh, absolutely. And that's something the Federal Reserve is going to be keeping a close eye on. Remember, they're trying to keep inflation under control. If they see signs that inflation is picking up, they might raise interest rates even faster.
Which would then put more pressure on the stock market. It's all connected, isn't it?
Exactly. The stock market is constantly reacting to all these different factors, economic factors, policy decisions, global events. It's a very dynamic system, and that's what makes it so interesting.
And challenging.
Yeah.
Especially for people who are trying to make sense of it all. But you've given us a lot to think about today. We've covered the manufacturing slowdown. We've talked about potential opportunities in healthcare and AI. We've discussed the threat of a market correction. And we've even touched on the possibility of tariff changes. What else should we be watching for as we move into the rest of January? All right, so we've talked about a lot of big picture stuff so far. You know, the missing Santa Claus rally, the potential for a correction, the rise of AI. But let's zoom in a little bit and talk about some specific stocks that have been making news.
Okay, sounds good.
One company that really jumped out at me this week was Walgreens Boots. Their stock went up over 27%.
Wow. Yeah, that's a big move.
What's driving that kind of performance? Is it just the fact that healthcare is seen as a defensive sector, or is there something more going on with Walgreens specifically?
Well, I think it's probably a combination of things. You know, the aging population is definitely a factor. There's more demand for healthcare services. And Walgreens is in a good position to benefit from that. They've also been making some smart moves, you know, trying to adapt to the changing retail landscape. They're expanding their digital offerings and focusing more on personalized healthcare solutions.
So they're not just sitting back and watching the world change. They're actually trying to stay ahead of the curve.
Exactly. And that kind of adaptability is really important for companies these days, especially in a market that's as volatile as this one.
It definitely gives investors more confidence. Now, on the other side of the coin, we saw Constellation Brands take a pretty big hit this week, down over 17%.
Yep.
What's the story there? Is it just general market jitters, or are there some specific challenges facing the alcoholic beverage industry?
Well, I think the overall market sentiment is definitely playing a role. But there are also some concerns about slowing growth in the beer market. Consumer preferences are changing, and that's putting pressure on traditional beverage companies like Constellation Brands. They need to adapt if they want to stay competitive.
It's interesting how even companies and industries that seem really stable can suddenly face headwinds.
Yeah, for sure.
It just goes to show you that you can't take anything for granted. You always have to do your research and stay up to date on industry trends.
Absolutely.
So we've got Walgreens potentially riding a wave of growth, while Constellation Brands is facing some tough challenges.
Right.
What's the big takeaway here for our listeners? What should they be thinking about as they make their own investment decisions?
Well, I think the main thing is you always got to do your homework before you invest in any company. You can't just follow the crowd or rely on past performance. You need to understand the company's fundamentals, the dynamics of the industry, and the company's long-term growth prospects.
And don't forget about diversification. Don't put all your eggs in one basket.
Exactly. Spread your investments across different sectors and asset classes. That'll help you manage your risk.
Great advice. Well, that about wraps up our deep dive into this week's stock market news. We've covered a lot of ground, from the missing Santa Claus rally to the potential for a market correction, from the rise of AI to some notable stock movements, and we've also looked at some key economic indicators. That suggests we need to be cautious and pay attention to how things develop in the coming weeks and months.
So it's been a busy week.
But hopefully you've learned a thing or two.
And are feeling a little bit more prepared to navigate the market.
Remember, knowledge is power, especially when it comes to your finances.
Absolutely.
Stay informed, stay curious, and happy investing.